Well, hi, everyone, and thank you for joining us today. Just a quick reminder as we dive into the discussion, please feel free to drop comments or questions into the chat. We may answer some as we go, but we'll certainly leave some time at the end for some Q&A. We've got a great panel of experts today to take us through the often murky topic of health plan funding. And for today's session, we're going to be discussing how to think about the various funding options that are available for your employer-sponsored health plan. And this is going to be the first of a multi-part series on the topic, so we're really excited to get this launched today. So we'll start with a brief round of introductions. My name is Bryan Davis. I'm the National Practice Leader for Nava Benefits. And for those of you who are just getting to know us, Nava is the first benefits brokerage oriented around the mission of providing high-quality, affordable healthcare to all Americans. And we're doing this by bringing the tools and the playbooks of America's biggest employers, the folks who are really doing this right, bringing that down market, all in an effort to make great benefits easy for mid-sized employers, easy to understand, easy to implement, and easy for members to access. So here with me today are two incredible thought leaders and experts in their field. We're delighted to have Todd Bisping join us. Todd is the Global Benefits Manager at Caterpillar. Todd, if you don't mind me putting you on the spot for a moment and giving us a brief introduction and telling us a little bit about yourself.
Yeah, well, thanks, Bryan. Glad to be here today. And so I lead our global benefits and health for Caterpillar. And that encompasses, benefits all around the world, including U.S. healthcare. But the challenges are global in nature. And one of the most basic things we deal with all over the world is funding. And so I was excited to be able to join today and share a little bit of some of the experiences I've had as we went through different challenges and how we looked at it and some of the changes we've been able to make over the years. So glad to be here today and looking forward to the discussion.
Great. Thanks, Todd. We're also excited to welcome Colleen Locke, who's the Director of Client Success here at Nava. Colleen?
Yeah, thanks, Bryan. Hi, everyone. Thanks for joining us. I am Colleen Locke. I lead our client success team here at Nava, and I've been in the benefits and brokerage space for the last about 11 years, servicing clients in all different industries from manufacturing to investment banking all across the country, and excited to talk today about the various different funding strategies that could be a fit for any of those industries and maybe you as an employer watching this webinar.
Great. Thank you, Colleen. Well, let's go ahead and dive into the topic at hand. In my nearly 25 years of advising clients in the employee benefit space, by far one of the most important and unfortunately confusing questions that organizations ask themselves is my company in the right funding arrangement? And today we're going to try to demystify some of those challenges that employers are facing when they are actually asking themselves that question. And so first, just to level set, probably want to just make sure we understand what we mean by funding arrangement. It's actually a pretty simple concept at its core. It's just how you pay for your claims. So your health plan is required to pay for medical and prescription drug claims that are incurred by your members. Essentially, employers can pay those claims in two ways. The first is that you pay an insurance company a premium, and then they pay the claims for you. The second is you pay for the claims yourself as they come in. That's really the two buckets. And today we're going to dive into a number of different flavors of each of those two themes. So on the screen, you're seeing the full continuum of options that are available to employers. And we're going to explore each of them in turn during today's discussion. So one just quick comment before we dive in. We often hear funding options are specific to the size of the company, i.e., if you're large, you should be self-funded. If you're small, you should be fully insured. And yes, while size is definitely a consideration, it's certainly not the whole story. There are things like appetite for risk or the internal bandwidth to be able to take on that funding change, and even things like cash flow considerations that are all part of that decision equation when moving to a different funding strategy. So for each funding option today, we're going to explore what it is, who it's for, and then some considerations that employers should take into account when they're evaluating these as potential alternatives. So let's check out our first, and I would say arguably most basic funding option, fully insured. So Todd, I think this is a great place to start, as I would suspect most of the folks on the call today are likely in a fully insured plan. So maybe a good first question is, if my plan is fully insured, what does that really mean?
No, thanks, Bryan. I think you're right. I think this is pretty basic and pretty straightforward and pretty common throughout the industry, especially with smaller companies and even large companies. I work at a large company, and over the years, we've had some products that have been fully insured. And, really all it's saying there is it's the model where an insurance company basically takes on all of your financial risk. You're going to pay them a premium, and they're going to cover your folks for you then. And so it's as straightforward as that. That means they're taking on the insurance risk, so you are fully insured. An analogy I sometimes give people, that I'm not sure it's a great one, but I use it anyway because they can relate to it, is, you get car insurance. You call your car company, you just tell them what kind of coverage you want. They look at your experiences, and then they rate you, and then you pay them amount of money, and then you have insurance for your car. It's not something that you have to figure out other ways to pay, but you know what your design is, you know how much you pay them, and then your car is insured. This is similar to that. And so it's pretty straightforward. And if you want to talk about, some of the pros and cons of that, if you think about it, what I'd describe is the most basic one. It's very predictable, right? It's a predictable cost. You're paying a fixed amount to an insurance company. You know that you're going to be able to budget that. It's going to stay the same every month. So it's very straightforward. That also makes it, another pro would be make it very administratively simple, because you're not having to keep track of much, right? You're basically handling, basically paying a bill, and then everything else is taken care of kind of for you behind the scenes after you have the contract. And it minimizes your risk, I guess, is what I would say. If you're thinking about insurance and you're thinking about some of the cost of some of the healthcare costs for claims that come in, you talk about some of these $1 million plus claims that hit you. It gives you a level of risk tolerance there where you don't have the risk because you passed it on to this insurance company. So, while that all sounds, exciting and fun, oh, this is simple. My decision is done. I just want to do it that way. Well, guess what? There's always some downsides to some of this as well. And I even implied that, in my roles, I have had fully insured products, but I no longer do. And the reason I don't is because of some of the challenges with it. You really do have limited control in what you're able to do, because you're buying a product. You might be able to set up the design and stuff as you go with it. But once you buy it, basically, and once it's set up, it's hard to make changes to that design, because your rate and your premiums are based on what you've selected. So that really just gives you a lack of flexibility. Your insurance company may have different rules and restrictions. They may limit your choice of providers or options. They set a lot more of the rules that come into it. And so it limits what you can do. And the other thing is even though it sounds great, just to pay a premium, well, guess what? Your future premiums are going to be based on your experience, right? And so insurance companies have things like loss ratios and all these fun insurance terms they like to throw out. And if they're not making any money off you, and if your claims are a lot higher than your premiums, you're going to get premium increases that you really don't have a lot of control over, other than going to the market again. And so it really limits you that way, because if you think about it, what is an insurance company in this for? They're in it for a profit, right? They're not doing this out of the goodness of their hearts. And so you're going to look at a situation where you have a company that's giving you a service where they're making money off you. So by default, you're spending more than you have to in the long run to give you that risk tolerance. So, and the last thing I would throw out, and to me, this, our company is obviously a larger company, so we're spread across multiple states. But if you have a fully insured product, you're subject to, each state's insurance laws and their mandates. And so if you have people in even more than one state, that all of a sudden becomes an issue, where every time some state legislature passes a new law and the governor signs it, all of a sudden you got to figure out how to put that into your plans. And if you have people spread out across the country, that becomes problematic and even costly. And so if you think about examples, for me personally, I told you I did have options that were fully insured for our employees years back, but I stopped doing it for two reasons. And the first one was I did have a situation where I had a fully insured product that was in an area where the employees, maybe the demographics and utilization patterns weren't great. And so the premium skyrocketed. And so I'm like, I can't control that. My costs are going up. What am I going to do to fix it? My hands were really tied, other than to try to squeeze. Well, you can't take that much. I was just basically a negotiation strategy. And we can do better if we have the ability to help manage it ourselves. And the other thing that happened to me is I had some employees in the state with a fully insured product, and all of a sudden they slapped on a whole bunch of state mandates. And not that all state mandates are bad, but these were very costly and not evidence-based, in my opinion, right? They were more political optics, I would call it. And I don't like to pay for political optics. And so we ended up, that being problematic for us. And so as I sit here today, examples like that are why, in my company, we no longer use a fully insured product, because that is one of the reasons that was important to us. So a lot of pros, but some cons that you got to factor in when you think about a fully insured plan versus another one.
Yeah, that the state mandates comment was really interesting, Todd. It definitely speaks to that limited control that you have in that fully insured environment. I think when a lot of people think about an insurance product from a group health plan perspective, they think about the renewal process. Like how does it get renewed? What does that look like? Colleen, I think most would say that the renewal process for fully insured programs is pretty straightforward, wouldn't you say?
Well, straightforward from the perspective that, generally the insurance carrier is going to do their underwriting and processing behind the scenes. They're going to hand you that renewal, and they're going to hope that you review it and accept it. But where it can get a little bit murky is that oftentimes there's just a lack of transparency into what goes into that renewal, what's making up that renewal increase. And, even though there might be a lot of back and forth and that renewal might come down pretty significantly from the carrier side, it's hard to really understand where that's coming from or what's driving that negotiation. And that lack of transparency can drive a lot of frustration from the client's perspective.
And do you think that lack of transparency is because the fully insured plans don't provide as much claims data as potentially some others do, some other types of funding does?
Yeah, absolutely. So when a group is fully insured, there's definitely less of an access to claims information. And, depending on the size of the group or, certain state laws, for example, you might receive some claims data, but often it's pretty high level, and it doesn't give you, as much insight as you might see under some more forward-thinking funding arrangements.
No, you're exactly right, Colleen, because it often is the case where they slide across the table, here's your new number. And they might give you light and say, oh, look what my loss ratio was. It was bad. Or here's 6 high cost claimants that were in your population this year. And that's all the more I can learn about them. And, there's some transparency laws in different states that are changing that. But at the same time, I definitely can't dial into the data to get the kind of information I need to feel good about some of the data increases that get pushed your way in that space.
Yeah, absolutely. And I know a lot of folks are concerned about when they're changing funding arrangements, either from fully insured to self-funded, whatever the case might be, that it's going to impact their employees' experience. Curious, Todd or Colleen, has that been your experience in the past in terms of when you change funding arrangements? How does that impact the employees if it does at all?
Generally speaking, there shouldn't be too much of an impact to employees when we're just talking about changes to the funding arrangement. Now, depending on what you're implementing, there could be, perhaps a little bit more education that might be important when you're changing strategies. But for the most part, if you asked an employee what their funding strategy would be, a lot of times they can't answer that question because it really doesn't change their own experience.
Yeah, I would concur with what Colleen's saying. Maybe the rare exception to that is once in a while when you make a change from fundings, you also are changing providers, and that might change network design and stuff like that. So there's occasions where you might be disrupting someone's network design, but most networks are so broad now, the disruption there is usually pretty low, but it can happen.
Great. Well, any other comments or thoughts, kind of parting comments on fully insured before we move to the next strategy we're going to discuss? All right, great. Well, let's move on. So, Colleen, even in organizations that are in fully insured programs, there's still some pretty creative financing alternatives that are available. I know one example is gap funding, which is our next strategy we're going to dive into. Can you tell us a little bit about gap funding?
Yeah, absolutely. So gap funding is a strategy that allows employers to save money on their fully insured premiums by effectively self-funding a portion of the medical plan. So gap funding reduces those premiums without changing the benefit levels that your employees are receiving from their perspective. And I think gap funding is usually easiest to understand if I maybe walk you through an example. So let's say you have a fully insured plan today that's got a $500 deductible. If you change that plan to a $2,000 deductible, your premiums are going to go down because now your employees have more responsibility with that higher deductible. But you don't want your employees to have to pick up that full $2,000 deductible. You still want them to only be responsible for the first $500. So with gap funding, what you can do is keep your employees responsible for that first $500, and then you pick up the excess until the employee has met that $2,000 deductible. So you're effectively reinvesting some of the savings that you're receiving from those lower premiums for having a less generous plan design to help fund the difference between what your employees are expected to pay and what you actually have to meet in accordance with that underlying carrier plan design. So the benefit there is that you're getting the savings because, most often not all of your employees are going to be meeting their deductibles or, making up that difference in plan design. So you're getting to hold on to those savings, and your employees are still getting the benefit of having that more generous plan design or what they were used to previously. So it's a good way to drive some of that savings without largely impacting your member experience. One of the vendors that we work with quite often in this space is called the Difference Card. So they have a really strong gap funding solution, and based on what they see across their book of business, the average reduction to health insurance premiums that their client base receives when they move to a gap funding strategy is about 18%. And this is what we see, when we have leveraged this internally with some of our clients as well. One of the clients that we have that used this funding strategy pretty successfully was a group that had very generous, fully insured plans, and they actually acquired another company. And they wanted both of those companies to be able to have those same generous benefits, but it became much more expensive when they rolled out those generous plan designs across that entire combined organization. But when they added the difference card layer on top of those existing plans, they were able to preserve that generous plan design, roll it out to their entire combined population, and still kept their cost at about a 17% reduction from where it would have been if they just moved forward with the traditional offering. So pretty significant savings on the table that were able to or allow them to continue that really rich experience for their employees. When you think about who might be the best candidate for a gap funding solution, it's going to be those employers that are offering a fully insured medical program that have pretty rich plan designs, because then it gives you, enough of a difference between those buy down or less generous plans that you might purchase from the insurance carrier to really see those savings to the fully insured premiums. And a group that has a good infrastructure in place to be able to communicate with their employees. I think a lot of times when we go through a solution like gap funding, people say, what's the catch? The catch, quote unquote, that I would say here is just that there is a change in the member experience in this scenario that we're talking about, and that we have to educate employees on, how the gap funding solution works, how they make sure that they're receiving their reimbursements or only responsible for their portion of those, their benefit costs. But if you have a strong communication strategy and a great plan in place with your, your HR team and your broker to be able to communicate really effectively, it can be a pretty seamless transition that employees can really appreciate to continue accessing those rich benefits.
Yeah, Colleen, you mentioned the gotcha for the employees that they have another step that they have to take in the process. Are there any gotchas for the employer around compliance or just additional administrative burden that they might have by putting a plan in like this?
Yeah, great question. So not necessarily a gotcha, as I would call it, but maybe a couple of additional administrative considerations. So when you are gap funding, that is considered self-insurance. So even though it's a small piece, you're introducing a self-insured component to your medical program. So you do need to be mindful of things like non-discrimination rules. So, some people might say like, hey, this is a great solution. Maybe I only want to offer this to my executives. That's not the type of thing that you can do with this program. You do have to be careful about those non-discrimination rules. And being self-insured, there's a couple of additional administrative components. So things like being mindful of needing to file your ProQuery fee in July of each year. So just a little things like that to keep in mind. On the flip side, another upside or benefit of introducing a gap funding solution would be more access to claims information. So as we were talking about in the prior section, when you're talking about fully insured plans, there's generally less access to data when you're gap funding a portion, you now own that information. So you are starting to receive information on, how your employees are using their benefit plans, how many people are meeting their deductible, what are the types of providers they're seeing. Of course, it's all anonymous, so still, in compliant with HIPAA laws and everything like that. But you start to get a lot more insight into how employees are utilizing their benefits, which could inform some future decisions about the plan.
Yeah, Colleen, you mentioned the importance of having a strong communication framework to roll this out effectively. Can you expand on that a little bit? What strategies have you seen work really well for communicating a gap funding solution?
Sure. Yeah, I think the key thing to communicating a gap funding solution, but really any new educational component that you're introducing to employees, is just repeat, repeat, repeat. I think having somewhat of a drip campaign. So starting that education process prior to open enrollment, for example, maybe it's a couple of emails, or, if you use a messaging component like Slack, sending Slacks out and just letting people know, hey, this change is coming, and starting to give them little nuggets about what to expect and how to start educating themselves, and reading up on different resources about the new arrangement that's going to be coming to them. And the key thing that we've seen work really well is continuing that education after open enrollment also. So oftentimes, there's a ton of information that's communicated during open enrollment, but it's a lot for people to absorb. So when people actually start, utilizing the solution, maybe the first time they go to the doctor, go to the urgent care, and they're using, their gap funding member resources, having those sessions where people can say, hey, this was my experience. Did I do this right? Or when I was actually utilizing this, I have a question, and just continuing to provide that education throughout the year and giving people the right outlets to ask questions and making sure that they're getting the most out of all of their benefits.
Great, thank you. So it sounds like for our gap funded solutions, we are looking at organizations that are in fully insured plans that ideally have maybe richer plans. It tends to work a little better for richer plans, and that have an infrastructure to be able to communicate effectively. And those could be really nice fits for those types of organizations.
So Colleen, a quick question I want to ask, Colleen, just on your thoughts on this, because we've never run a gap plan where I'm at, although I'm familiar with them a little bit from looking into different things. I would think culturally, from a company standpoint, this would be attractive if you have a company that's not adverse to change, or has a culture of expecting their people to be able to do a little bit themselves and understand and learn some things, versus maybe a paternalistic environment where everything is supposed to be very handed to people and clear. Do you find the additional complexity is difficult to manage when you turn these kind of plans on for folks? Is it a challenge to do that change management, or is it pretty straightforward? Because there's real value here if you're not scared of that aspect of it.
Yeah. I think you'd be surprised with how adaptable most employees tend to be if the communication is strong and very clear. So we've actually seen success with this with all different types of organizations. So I wouldn't say that, I would kind of box this to groups that are, maybe a little bit more flexible or less paternalistic. I think any type of industry or culture can have success with this type of arrangement if you're just willing to do or to put in the time and the education to employees so that they feel set up for success. But there's also different ways to approach this. There's I would say different levels of complexity that could come with gap funding. You could have a plan that is, just deductible funding, sort of like the HRA model, which is pretty easy for employees to grasp and understand and utilize. Or it can be more complex when you're talking about funding, copays and prescription drug payments. So there's also a spectrum, and the more complexity or the more layers of gap funding, I would say the more education would be required. But in general, I think most groups, are able to roll this out quite successfully.
Thank you, Colleen. So let's go ahead and jump to our next strategy, level funding. Colleen, I often talk about organizations that are getting into self-funding, and they kind of do a little toe dipping exercise just to test the waters a bit, kind of understand how it works, and just make that eventual transition a little bit easier. And I know gap funding certainly fits that bill. But level funding does as well. Could you tell us a little bit about level funding?
Yeah. If gap funding is the toe dip, level funding is maybe the stepping stone, as you said, to get a little bit closer to self-funding. And level funding is a type of self-funded plan. So it's not fully insured. It is on a self-funded chassis with the insurance carriers. And level funding allows the employer to contribute a steady monthly payment to cover the costs for their administration and claims costs, as well as their stop loss, while reaping some of the benefits of a self-funded program. So it feels to the employer very much like a fully insured program where you have, those set monthly payments again, so you're not dealing with claim fluctuations. So it's very easy to budget and control costs, much like the way that you think about a fully insured plan, but you have the ability to participate in the upside of the plan. So one of the components that's built into those monthly payments that you're making is an estimate of what your claims are going to be. And if you get to the end of the year and the claims that your employees have incurred are actually less than what they were expecting, you have the ability to receive a surplus credit that would be applied to your costs for the following plan year. So there's potential savings and potential upside without the risk of self-funding, which can be pretty attractive to groups that might be a little bit smaller, maybe a little bit risk averse, not ready to fully jump into self-funding, but want to get used to what those different administrative or claim components look like. Get more access to their claims data so they could really see what's going on under the hood in terms of their plan experience, and be able to potentially get those savings credited in future years. I think, when we talk about that potential surplus, the natural question is, well, what if I'm in a deficit? Do I owe that money back to the insurance company? And luckily, the answer to that is no, you don't owe those actual dollars. But of course, it does get calculated into your renewal increase for the following year.
Yeah, one of the things that we talked about as a potential con or consideration for fully insured was access to data. How is that different in a level funded arrangement?
Yeah. So you have full access into your claims data when you're in a level funded arrangement. So since that's considered self-insurance, you have access or you own all of the data that is under your plan. So you can see, your full claims experience. You have more insight into those large claimants. You can track things like your loss ratio. And over time, you can really start to use that information to get more insight into what are some future considerations under the plan. So, you can see things as granular as the types of prescriptions that your employees are taking. So when you're reviewing that information, maybe there's information that we're seeing where, hey, a lot of your employees are actually using prescription drugs that could be easily switched to generics. That could be some significant cost savings to the plan. Or maybe there's a lot of individuals who are, going to the emergency room for visits that could be better triaged in an urgent care center. So just starting to get some ideas like that of ways that are either real changes that you can make to your underlying plan structure, or just educational opportunities that you can use to drive some savings in the future. Some of the other upside or pros when you're thinking about a level funded plan is you definitely have more flexibility in terms of your plan design as well. So since you're moving to more of a self-funded arrangement, you can, you have more access to tweak those plan designs, make different changes in deciding what benefits that you want to offer to your employees. And you also have the benefit of not paying those state premium taxes. So that's also a cost savings compared to a fully insured medical program as well.
Yeah, one thing I would maybe add to that as well is or at least a tactic that we see used with level funded where it fits really well is in states where you have small group rates. Oftentimes those are age banded rates, which can be kind of administratively difficult to manage for an HR team with the Ben admin systems. Level funded is certainly a viable option in that small group space, and typically looks more like what you see a large group rating look like, a 3 or 4 tier rate that's much easier from an administrative standpoint. So we do see a lot of small organizations moving to level funded just for some administrative ease, and to your point, Colleen, the ability to get some of their data so that they can access options in the future.
That's a great point.
All right, so we will keep moving down the continuum here to our next strategy, which is the captive strategy. And Todd, in my experience, the financing option that tends to get the most scrutiny from employers is the captive. And I think it's a bit understandable because it's probably the most unique of all the options that we're going to review today. I guess from your perspective, what is a captive and what makes it so unique?
Yeah, it is really quite unique. And, as I talk to folks, it's often the one that doesn't even get brought up, let alone scrutiny, right? Because it's not super common, but it's a real viable option depending on the circumstance that your company's in and what you're trying to accomplish. So in essence, a captive is really, a type of insurance that you really form your own insurance company. You kind of either do it yourself or you pool up with some other companies, and then you provide the coverage for your employees' healthcare expenses. So think of it as it's not, if within your company you have your own plan that you tend to fund things through, but this is a separate entity from that, and you set it up to be an insurance company to provide those benefits and to pay, not to provide the benefits, but to pay for the benefits, right? That your plan does. And so why would you ever want to consider doing that? Well, there's some things that are pretty good about it. I mean, as compared to, a fully insured thing, you really can get a lot better control of your own healthcare costs. You can manage them better yourself by having more data and also by having more ability to set the premiums and the charges that you want to use in the captive. Because in essence, you've made an arrangement with another insurance agency or even your own to do that. And so it allows you a little better ability to do that. If you're doing with other organizations, kind of a joint captive, then you're able to pool that risk a little bit better. So there's some real good things in there. It also brings a lot more flexibility than compared to, like a fully insured product where you really can do the design that you want to set up for your plan designs and for your benefits, because again, you're paying for them. You're the insurer in essence in this scenario, and you can make that happen. I also feel like, I don't know if this is legit or not, but I feel like it creates more long-term stability. Because when I'm playing in a fully insured market, I feel like every year I might have to be whipsawing my people around from carrier to carrier, plan to plan. I can save 5% here. Are they just, loss leader selling me and they're going to ding me in 2 years with a big premium? Oh, guess what? I'll yank it over here. Here I really feel like I can set up something that brings me a lot more stability over the long run, because I can control how much the increases are, if there's any increases, and it really makes it more viable and sustainable for my organization to do it. Now, what would be the challenges with that? And I really think it falls down to initial setup costs. I mean, to get this figured out and get it to do it, it requires some significant expertise and some significant time to get it set up right and to do it right and to convert things into it. I mean, there's even things around licensing and capitalization and all that kind of stuff that you got to justify before this would work for you. And again, I also would point out that, you are, even though you're insuring it through the captive, you are still assuming that risk, right? Because the captive associated with you. So you are picking up that risk is part of that. So why would anybody ever go through all this? Well, I mean, because I tell you, there's a lot of good reasons that folks do it. And I mean, I would even say that we do it at Caterpillar, right? And we don't do it in the U.S., but we do it outside the U.S. And the reason is we have business in a lot of countries. We could have done it in the U.S., but we chose not to because the same reasons didn't apply, to be clear. But we have a business in a lot of other countries, and it was a lot of plans, some of them small, some of them a little larger, but in a lot of different countries. And so we had a lot of different relationships with a lot of different consultants, brokers, HR departments, business departments, and not only in every country, but within every region of country, and by putting in and plus then we started to see overseas what we've been seeing here in the US for years is rapid trend growth. And again, I'm right back to what I started with. Well, what's driving that? Oh, your claims experience. Oh yeah, that's an easy answer. I wish I could answer questions that way. But that's awesome. In some of these places, that's all you could get. And so by putting a captive in place, we have our own captive that we now finance those benefits through. I now have access to the claims data. And then I also have the ability to set the premium rates for my company. So, I mean, if I'm having a really bad trending company, or if it's been pretty slow and I had a big jump, and I know right now that in that country, business conditions are tight, I can choose to spread that over a couple of years and and capture it that way. It just gives me a lot more options on how I want to finance and support the business. And that can apply anywhere. And whether you have business out of the U.S. or not, I'm just using that as an example of why it was so good. But it's also why my first con to it was the whole concept of the setup, because it did take us a while to do that, and I actually enlisted external help to help me do it at first, because it is pretty complex to make that happen. But at the end of the day, it's been a great story. My costs are down, my governance is up, my flexibility is up, my access to know what's going on is up. And now that it's in place, I'd never take it out because it brings that much value and ease of administration now compared to what I was doing now that it's set up. So it's been a real good.
Yeah, it's interesting, Todd. I know in my experience, I've worked with clients in a number of different captive scenarios, and in some cases, it works exceptionally well. In other cases, it can be a little bit of a challenge for that organization. And I think a lot of, at least my personal opinion on captives, is more about getting the right fit from an organization instead of what they're looking for and what a captive can provide, than a captive being a really viable solution for everybody. It really is looking for the right fit with that organization and what they're looking for out of their health plan.
You're exactly right, Brian. I mean, and like I said, I looked at it for the whole world, including the U.S., and for all types of benefits, right? It doesn't have to just even be healthcare. You can insure all types of benefits this way. And but the story didn't make sense in these other markets, right? It didn't make sense for a variety of reasons I won't go into here. But getting down into the weeds, we said, yeah, it doesn't work here. It's not a good fit culturally. It's not a good fit financially, and it doesn't bring any extra value for the complexity it would take to set it up. So no, we're not going to change it here. And so, yeah, so it's really a lot about your cultural fit and what problem or what challenge you're trying to fix.
Yeah, and the one thing I might add to that is, I know over the last probably 5 to 10 years, there are a number of captive solutions that have risen domestically for health benefits in the U.S. And one of the things that we've noticed from a brokerage standpoint is they've really done a good job of making them easy entry and easy exit, and feel a lot more like a standard carrier, as opposed to a separate insurance company that you have to build yourself and then do all this. They have all that set up already, so you get some of the advantages, but not quite as much of the disadvantages, if that makes sense.
A little more plug and play.
Yeah, totally. Well, and Todd, it sounds like captives are definitely a good solution for the right organizations, and we can kind of move on now to self-insurance. And I think throughout the discussion today, we've used the term self-funded quite a bit. And what we've looked at is essentially just various flavors of self-funding, whether it's captives or level funding. So love to dig into the kind of the core concept of self-funding itself. And so, Todd, again, what are some things that employers should know about a self-funded health plan?
Yeah, and so self-funded is the opposite of fully insured. I mean, because now it's you go to an employee goes to the doctor, you get a bill, you pay it. I mean, in essence, that's the difference, right? And that's the term self-insurance or self-funded. And you say, oh, that sounds risky. Why would I ever do that? Well, if you think back to our initial conversation around fully insurance, what did we say one of the cons was, right? There's obviously a profit motive for the insurance companies to offer a fully insured product to you, or they couldn't be profitable. They couldn't offer it. Well, in a self-insured mode, that margin stays with you, right? Because you're really just paying for the cost you want to do. So you basically, where I said in fully insured, the risk was assumed by insurer. In self-insured, the risk is assumed by you, the employer. And so that's why it's another thing that a company has to ask: what's our culture? What's our fit? What values us? Because now you might pay someone to help you do all the administrative parts of that, but the funding is going to be something you fund out of your own company's trust or whatever you would set up to fund that way. So what are the why would you take that extra risk on it? Well, the big thing is just the cost savings, right? I mean, like I said, when I moved away from fully insured, I had a lot of good reasons, but even with those good reasons, the biggest one was it was cheaper, right? Yeah. I mean, we could manage the risk. My company was large enough to manage the risk, and so we could put it in place to do that. Some people put in place things like stop loss insurance if they're self-insured. In other words, let's say you put a stop loss in where if a claim exceeds X amount, you just say $1 million for a nice round number, it could be a lot lower than that. Then the stop loss insurance will kick in and pay the above there. And so that's what some folks do to protect that. But in the case of my company, I don't even pay for that because the value in that is what it would cost me to buy it. I'm fully confident in being self-insured in that space as far as funding. It also gives us a ton of cost transparency because now we have all of our claims. In fact, I even have a whole database that we have that all my claims feed into. So I can do analytics on my own claims. Again, depending on your company size and your staffing, there's a lot of variance in how much you would or wouldn't do in that space. But that gives me a lot of insight into problem areas. I can catch trends before they become problems. It's really helped me and my company to manage our trend over the years to a very, very low rate compared to the industry, because it allowed us to do all those things, plan customization. Even if you want to talk to your finance people, they'll tell you things about cash flow management and things like that they now can control through about when they want to fund the trusts or how they want to fund the different mechanisms that they use to do that. So there's a lot of good things that can come out of it. But like I said, there's always the downside. There's clearly the most obvious one is the financial risk, right? You get that $5 million claim, you're writing the check, right? You're doing that. To protect against that, you got to spend extra for stop loss insurance. So that's another con. It's a little more complex administratively, especially if you do the things that we do, as far as managing and trying to keep on top of our costs and our trends. So you have a little extra there. And then, while the fully insured products have to deal with all the state regulations, you still do have to worry about things at a national level as well. I mean, you have, most self-insured plans for large companies fall under something called ERISA, which is, I don't even remember what it stands for, Employer Retirement Income Security Act, maybe. I pulled that one off my head if I got it right.
Bingo, you got it. You got it. Well done. Well done.
Yeah. So it's better to be lucky than good. But so you have to follow that, but it also provides you advantages because when you're self-insured, then ERISA allows you to just run one plan across all the states, and so you don't have to worry about all those state regulations. Mm-hmm. So all in all, self-insured has been a big win for my company and our culture and the way we choose to manage healthcare. Does that mean it is for everybody? Of course not. But it always goes back to the point that I think all three of us keep making. There's no right or wrong answer here. It's you got to decide what you're trying to accomplish, what challenge you're trying to solve for, and what your company culture, risk tolerance, et cetera is. And you can find one that really wins for you like this has done for me.
Great. So let's keep moving on to reference-based pricing, which is our final strategy we're going to explore. So Todd, reference-based pricing is kind of a newer funding option. I think it's really come about in the last, maybe 15 years or so. And it seems to be gaining popularity. And although I know it does have quite a few significant, in many cases, pros and cons. What should employers know about reference-based pricing, and how should they think about it within their strategy?
That's been buzzing around in the innovative space for quite some time because it sounds like such a pure and simple and smart concept. So what is that pure, simple, smart concept? You take a procedure or a code or a service that you have to pay for, you find what the best or the right price is for that, and that becomes your reference price. And you say, employees, insurers, or providers, hospitals, if you're getting your knee done, here's the reference price for that, and that's how much we're going to pay. And so it's usually based on a provider that you found that will do that for that cost. You found a good, high quality, low cost provider that will provide the service at that rate. You say, go wherever you want, anybody, but we're going to pay $1,000. And if it's $1,500, that means, guess what? You get to pay $500 out of your pocket, or the facility has to figure out how they're going to cover that. And so it becomes an issue of, hey, we did our homework. We found the best place to get this done. This is the reference price that can be done in the market for this spot, and we're going to pay for it. And so doesn't that sound so intuitive and easy and wonderful? Well, and it is intuitive, but it does a lot of great things. Talk about cost transparency. I mean, boy, you know what you're going to get going in, and isn't that one of the big challenges we're all trying to solve for? Is how to get that transparency to know what something's going to cost us. And it encourages competition, in the marketplace, because then all of a sudden someone says, oh, the reference price is 1,000 and we're doing 2,000. We're going to look terrible. We need to figure out how to be more efficient and bring our prices down. And it even does provide flexibility and choice for employees. If I really want to go here, well, guess what? You might pay more, but you have the flexibility to go there. I guess the last thing I would throw in is, of course, then the concept is here, it's going to save us money, right? Because now you've set a reference price that you think is a good price, and that's going to drive all your costs to that price. Now, again, with all good things must come challenges, and there's usually a limited number of providers who provide at the reference price, depending on the service, right? And depending on the market. But a lot of times there's a limited number of people who provide at the reference price, especially at first. And so what that means is you might have some disruption of your employees who have been going some for a while. Now all of a sudden the reference price is bad compared to where they're going, and they're going to have to disrupt or pay a lot more. You got problems with some administrative things like balance billing and how they collect and how people pay for that kind of stuff. And it is more complex administratively figuring out how to do it. And some people would even argue that it's a quality concern, because too often the reference price isn't based on value, like I like to measure it, cost and quality, but just cost. And so there's the occasion out there where there's, a reference price might not be at the best quality location available.
Yeah, Todd, that was really interesting. You made a comment about value as opposed to cost. Can you expand on that a little bit?
Yeah, and so when we look at where we want to send people to and where we want to refer, some people talk about, I always want to go to the high quality provider, and some people say, we should always send people to the low cost place. I don't measure either of them independently, because to me, I measure healthcare on value, and that means I'm sending my folks to the combination of the lowest price and high quality. So think about I always think of it, here's a quality line, whatever percentile you want to pick for the procedure, and you got to be above that quality line, or I don't want to send people there. Now, once you're above that quality line, now how much do you charge? And then I'm going to pick the top half of those and say, okay, now those are my 5 best high quality, lowest cost providers, and that's how I would set a reference to do that. And that then provides value versus just a cost as far as setting your reference-based price. And so, but what happens, I think, that really disrupts and prevents people from doing this the most is oftentimes it's hard to have data at people's fingertips what the reference price is. I mean, we continue to slowly get better in that space, but I mean, this concept's been around for quite a few years now, and especially in the early years, people had no idea what the reference price was, right? And so
what am I going to pay?
Yeah, exactly. It's like, this reference pricing sounds cool, but where's the data? I don't know. I guess let's go figure it out. And so that turned into a lot of confusion and disruption. Kind of gave it a bad name in some circles, but the concept is still valid. And I have not implemented what you would call a peer reference-based plan design. But what I have done before with groups of providers is set a reference price in contracts, because I do some contracting, and I've basically sent out and said, I don't want to call any certain group of providers out, but I one time sent out a reference price contract to over 100 providers and said, this is our reference price. This is what we value as a high quality and a good price. And you can either move to that market price, or that's what we're going to reimburse. And you have to, balance a bill or do whatever you want to get the balance. And guess what? Mass movement to that price. And so it was a real success because we had data that allowed us to set a reference price from a contracting perspective, and then the market moved to it because we had the right data. So it really can save money and drive value if you're willing to deal with the administrative complexities of it.
Yeah, absolutely. Colleen, it's interesting. I think similar to some of the other concepts we talked about, it sounds like for reference-based pricing in particular, employee communication strategy is probably critical.
Mm-hmm. Yeah, communication is definitely key. As was mentioned, the reference-based pricing strategy has the potential to be probably the most disruptive to employees. So making sure that they really understand, what the changes in potential looks like here is key. One of the things that we have seen in the space recently is that there's more vendors popping up who really focus on administering reference-based pricing plans, but with a kind of member-centric outlook. So making sure that employees have, the tools to find those providers that are not only low cost, but high quality, and direct them to the right types of care, supporting people if they do receive that balanced bill or have claims that are outstanding for a significant amount of time. So some of these TPAs that are really focusing on allowing employers to use the strategy and drive a lot of savings, but also helping the members through the potential bumps, I think have been really helpful in making this a little bit more palatable for the member experience.
I think that's a great point, Colleen. And I'd just be curious if you've seen a big shift in that here in the last few years as more and more data becomes available and transparency becomes more of a, it's not only becoming a market demand, but even a legislative demand in some areas. Right. And my hope has always been that we'll see that cause movement in these kind of spaces that allow better tools, easy access, grab your smartphone and it's right on there. Are you seeing that kind of stuff in your most recent times when you've found clients who've used reference-based pricing?
Yeah, definitely seeing more of it. I think there's still a ways to go, but to your point, even with some of the recent, legislative changes where there's mandates about what needs to be reported and the cost for certain types of care, I think that information is going to become so much more readily available and is going to make these existing systems and vendors even more robust and accurate as more and more information is just freely available.
No, that's a great point.
Yeah. Well, I think we have we can declare victory on our various funding alternatives here. We did have a few questions that came in that I will throw out to the group. Can you explain bundled versus unbundled for self-funded?
Colleen, take a stab at that, and feel free to jump in. Sure. So when we're talking about that self-funding arrangement, one of the pros is that you do have flexibility with the vendors that you're working with. So if you're thinking about your fully insured plan, you have your network, your administrator who's adjudicating those claims, your pharmacy option, that's all going to be under one umbrella. So it could be Aetna, for example, or Cigna, who's doing all of those things for your employees. You can have a self-insured plan that feels similar, where all of those different aspects of your healthcare program are being done by one specific vendor. And that's going to be your bundled solution, where one person is responsible for that network access, for your claims processing, for your stop loss if you have that additional protection. Or you can look at unbundling those things where, maybe you keep your medical network and your claims processing with Aetna, but you actually want to carve out that pharmacy piece and look at, what might be called a PBM or a pharmacy benefit manager who specifically focuses only on, prescription drugs and access and formularies and how to get the most out of that benefit. And there's a potential to really drive costs down when you think about carving out something like your pharmacy benefits. And so when you start taking those pieces apart, that is unbundling the plan. So you can do the same with stop loss. If you look at a stop loss vendor that is separate from that administrator and network piece, you'd be unbundling that component. There's definitely cost savings to be had when you look at unbundling those different pieces, but there's administrative considerations as well when you're thinking about now you're working with several different vendors. And also, thinking back to the question at the beginning is, are your employees even aware of different funding arrangements? If you start unbundling and, for example, you have your pharmacy that's separate from your medical network, that's an additional component that we want to make sure that people really understand and have, the right resources to know where to go for, in-network care, et cetera.
Well, Colleen, you nailed that one because you not only answered that question, but you answered another question that came in, which was, what is a PBM and where does that fit in? So very well done.
2 for 1.
Extra points for Colleen. Good job.
There you go. I've got one last question here. What information would I need to gather to evaluate these options? I can probably take that one. I think first, I would suggest reaching out to your broker and just asking for a data request. Typically, you're going to need an employee census and then any claim experience that is available for your current plan. And then there'll be some variations and flavors of that depending on what option you're looking at, but those are typically what you're going to need to pull together. And if you don't have claim experience, your broker should be able to advise you on the best course of action there. So the short answer to that question is talk to your broker. They should have a good plan of action on how to go address that. All right, well, that should wrap us up for today. Thanks everyone for joining. We are going to be hosting deeper dives on each of the funding options that we talked about today in future sessions. So consider those the 201 level look at these. So keep an eye out for that invite. And separately, if you need help analyzing your current benefits, feel free to send me an email personally at Bryan with a Y at navabenefits.com. I'd be happy to set up a one-on-one with our team. And we'd be happy to pulse check your program and see if you're in the right funding arrangement or if you want to make a change. Colleen, Todd, thank you so much. Really appreciate your participation today and enjoyed the discussion. And thanks for lending us your expertise. So thanks everybody. Have a great day.
Thanks, everyone.
Thanks. It was a pleasure. Have a great day.
Bye.